Thank you, and thank you, Cindy, for that great welcome introduction. This is Charles Dobbins, the multifamily attorney and the founder of the Multifamily Investing Academy, and I am here with my client, my friend, the CPA emeritus of the Owner Forum, the go-to guy in our group when it has anything to do with the taxes and the accounting of the taxes, Mr. James Liechty. Welcome, Jim. How are you?
I'm doing great. How are you, Charlie?
Good, good. So the topic today is one that every multifamily investor needs to understand. And the nice thing about this is that, you know, I teach a portion of my class on the accounting for multifamily, but my background or my understanding is more on the managerial accounting side, not on the tax side. Tax accounting is lost on me. So I am going to interview you on the topic of cost segregation, and you're going to be forced to break it down to layman's terms so even I can understand it. So,
sure.
All right. Good.
I'd be happy. And Charlie, I'm honored to be on your podcast. I think this is great. Very exciting to have a podcast going. So
yeah, I know it took me long enough. It took me like 50. It took me about 50 years to get a podcast going. I finally decided to do it because, you know, I didn't think the internet was going to catch on, and finally I'm catching up to the podcast idea concept. So here we are. All right, good. All right, so what we're going to do here is we're going to talk cost segregation. For some people, their eyes glaze over, but we're going to make it very simple so that they understand why they need this, why they need to understand this, how this can impact their ownership of multifamily. So
sure.
Let's start with the most basic question, which is, what is cost segregation?
So cost segregation, in a nutshell, it's simply the acceleration of depreciation deductions.
Okay.
And providing the documentation and support for that if the IRS were to come in and look at what you're doing.
Okay. So, now explain to us, and this is, I told you we're going to go right back to the layman's terms, accelerated depreciation. Now, I understand it, but I want, some people like, oh, geez, this is now getting gray for me. Explain accelerated depreciation and why it's beneficial.
So here's what happens. When you buy an apartment complex, you're really buying, in the IRS's view, you're buying land, you're buying a building, and then you're buying personal property, which is stuff like the carpet and cabinets and things like that. And very often what happens is, you know, a lot of CPAs or tax return preparers, what they'll do is they'll make an allocation between land, which you can't take a depreciation deduction for that. You've got to wait to recover the cost of whatever you paid for land when you sell the property. And then everything else is depreciable. So 27.5-year property, let's say you buy a building cost, you got $1 million or $2.7 million, let's say, that's allocated to the building. You're going to recover that $2.7 million over 27 years. So you get basically $100,000 a year in a deduction. If you do a cost segregation study, you can take the amount that's allocated to the building, and you can recover some of that over a 5-year recovery period, some over a 7, some over a 15-year recovery period. And so the net effect of that is that you front load your depreciation deductions. So your depreciation deductions in years 1 through 5, I don't have the exact numbers on this, but you know, they could go from $100,000 up to $300,000 or more, and you have that deduction for 5 years. And then after your 5-year property falls off, then your deduction falls down to $80,000 a year or something like that.
Okay.
So your total deduction is not going to change. It's just going to front load.
And so, No, so all of these deductions, this is where it comes down to doing the tax return for the property. It means we're not paying taxes. We're paying a lesser tax to the IRS than we would have without the cost segregation.
That's exactly right.
Yeah. Okay.
And one of the big benefits. Now, there's a couple of things, rules of thumb I use for cost segregation. Sometimes it makes sense to do a cost segregation study, and sometimes it doesn't. So where it does make sense is where you own property, you're paying tax, and you can use additional deductions. So a common thing that can come up in multifamily and investing in real estate for tax purposes is if you're considered to be a passive investor, so you're not a real estate professional,
right,
your depreciation deductions can be limited. So, you know, in that situation, maybe it doesn't make as much sense. Another situation, another factor that I think you want to consider if you're going to do a cost segregation study is how long are you going to own the property. If you're planning on flipping the property in a year or two, it probably doesn't make a whole lot of sense to do a cost segregation study. The
Okay.
rule the rule of thumb I use is about, if you're going to hold property for about 5 years or more, that's when it starts to make sense.
Because then especially because some of those expenses are within that 5-year schedule. I think what you have
Yeah, well, it's really a time value of money play when you come down to it, and a net present value play.
okay.
Because really, what you're doing with cost segregation is you're taking depreciation deductions from year 27, and you're moving it to year 1.
Okay. Now,
Right. So when you get, that's the way the more sophisticated investors will look at it.
now what we're doing here is, like, for instance, I remember listening to one particular accountant talk about this. Like, for instance, the asphalt and the the curbs, those get segregated out, and they're accounted for differently in the equation. Is that?
That's right.
Yeah.
Yeah. So the parking lot would be a 15-year property, or a 15-year asset. So parking lot, sidewalks, landscaping, trees, shrubs, stuff like that. So, and it's really, and one thing that's just absolutely huge here, Charlie, is the new 100% expensing. So anything that you identify as a 5, 7, or anything with a recovery period of 20 years or less. So your carpet, your cabinets, your office furniture, your parking lot, your sidewalk, shrubs, all of those things. Now there's a bunch of requirements to be met, but generally, if you're buying a property that's new to you after September 27, 2017, all that stuff's going to qualify for 100% bonus. And so you can deduct that all in the first year. And so if you have I was running a few numbers, it depends on, all these numbers depend on the property and they vary quite a bit. But if you have a $5 million property, typically about 15% of what you pay for that property will qualify as 5, 7, or 15-year property. So 15% of 5 million is $750,000 deduction. And if you're at a 40% tax rate, what is that? That's, I think, about a $300,000 reduction in taxes that you pay.
Nice.
So and that's all in year 1. So it's a huge. If you can use the deductions, it makes a lot of sense.
Okay. All right. Now, what if you're looking at a property? What types of properties would benefit from cost segregation? I mean, if a student or a new investor or anyone looking at a multifamily deal, when should they look at that deal and think, "Hey, maybe I should give Jim a call about the cost segregation"?
Yeah. So it's really any property you're purchasing. I mean, some of the criteria I use, there is a cost to doing a cost segregation study. It takes time to do it. So the criteria I use is generally if the property has a cost of $1 million or more, you start to get a pretty good benefit. So cost $1 million or more.
It's going to be a dollar value that they're looking for, not necessarily a type of asset.
Well, I was thinking more on multifamily properties here.
Okay.
So if you have, student housing or just a regular apartment building, in a kind of a commercial area, the numbers are going to be pretty close. You can do cost segregation, of course, for office buildings and industrial and stuff like that. If you start to get into industrial and warehouses, I've seen industrial projects where you're able to put more than 60-70% of the cost of the building into equipment. But in an apartment setting, you're probably not going to get anywhere near that close.
Right. Sure.
So, but one thing that can make a difference too is if a student or someone is considering doing a furnished apartment, then all the furniture gets put into your shorter life property. But yeah, I mean, if you're doing like a garden apartment type, this is compared to just like a high-rise apartment building, you're going to get differences in the amount of property that is going to be recovered over a short period, but generally they're not going to be huge.
Now, Jim, why doesn't your CPA do this for you anyway? I mean, why don't CPAs just do this automatically?
Yeah, so that's a great question, Charlie. A lot of times CPAs doing a cost segregation study requires a specialist skill set. And you need to have a combination of knowledge about the tax recovery period of all these different assets. And then also it's generally construction knowledge to know how to break the building into all these different assets. And what I find a lot of times is CPAs I think the most common factor is they generally just don't have the time to dig into and break everything out. They might do a high level estimate. That's pretty common. Break it out into land and 27.5 year property and then leave it at that. But a lot of times they don't have the expertise also to get in and do all the breakout. So that's generally what happens.
Now, when somebody does this analysis, let's say if you're in the owner forum, we use a cash flow analyzer from Doug Rutherford, who's another CPA. And in his equation, he's got a breakdown where he allows you to allocate, how much of it is land and how much of it is improvements.
Mm-hmm.
But that's if we put that into the cash flow analyzer, the savings or the benefits that we see to that will only really apply when we look at the rates of return, the cash on cash return after taxes, right?
Right.
Okay.
That's right. This is all after tax. So, one way that an investor in a multifamily property could benefit from a cost segregation study is, number one, to the extent they're an owner in the property, they'll get additional depreciation deductions. If they're a real estate professional, then oftentimes the benefit of the cost segregation study, the deduction will be so large it'll wipe out all the income from the property and then put them in a loss so they can use that loss against other income. But another benefit, which you're bringing up, is additional deductions for other investors.
Right.
So if they can use, if you're syndicating and you're pulling the investors in, those investors will use those deductions. And then depending on how you're structured, if you're in a partnership and you've got some flexibility on how you allocate income and deductions, you can do prorated allocations of your depreciation deductions, or you can do special allocations. If one partner is saying, hey, I'm a real estate investor and I really need a lot of deductions, this is a way you could give them more deductions.
Okay, let's talk about this for a second, because this one is, I think, a huge element to syndication that new investors don't quite understand. So let me give you a scenario. You kind of walk me through it. So sure. I'm out there, I'm trying to raise $1 million to do a particular deal. I write the offering memorandum and I write the PPM, and we do all this securities work, and we set it up so that all investors are treated exactly the same. We get X number of percent. I get 50% of the deal. Everybody else gets 50%. The distributions come in and they go out. Now, in addition to let's say that all of my investors are full-time real estate professionals that qualify. I can take the depreciation, like off a cost segregation study, that we're going to apply to this particular property, and I can distribute that differently as long as I've drafted in the PPM and it's disclosed. I can actually sell my syndication such that real estate professionals who come into my deal will get a different schedule of depreciation, or they'll receive more depreciation off the property than other investors. Is that what you're saying?
Yeah, that's right. That's right. I mean, you got to be careful on how you set it up, and you really need to talk to a CPA or an attorney to get it set up right. In some instances, depending on the entity you use to set this up and how your documents documents read, you may bind yourself and not be able to do that.
Right.
But if on the front end you're planning and that's what you want to do, and you tell the tax attorney and your CPA, hey, I want to do this, I want to have the flexibility to do this, then yeah, that's something that they should be able to put in your documents to help you do.
Okay, so when I'm analyzing the deal, when I'm starting to put the deal together, when do I contact you for the cost segregation study? When do I say, hey, Jim, this is something I'm thinking about doing. What do you think?
So there's a couple of times you can contact. One is when you're evaluating a property, it's probably better to get it a little further along. Maybe you've got it under contract, or you're seriously looking at the property. You can contact me. I can give you a high level estimate of what the cost segregation benefit will be. You know, before you have it under contract, it's all, you know, you're kind of planning. You don't know what's going to happen. We know sometimes these deals fall through. Sometimes they end up going to fruition. But that's one touch point. Another point is when you actually close on the property, or you're getting close to closing and you know you're going to close. Then you can dial in the estimate of what the deductions will look like. Does it make sense to do one or not? They can provide an estimate on the cost it will take to do a cost segregation study. Typically, what I find when I do these studies is that your return on investment, I always kind of joke, if I could get the return on investment in the stock market that I can give a client on a cost segregation study, I would only be investing in the stock market. The return on investment can be between 10 times the cost of the study to 100 times the cost of the study.
Yeah.
You know, so if I can go into the stock market and get a 10 to 100 time return on investment every time I did it, you know, it's a no-brainer.
Yeah. Yeah.
But the, you know, the larger the property, typically the larger the return on investment. There's economies of scale for doing things. But yeah, when they, you know, certainly if they're got a property under contract, or they're very seriously considering a property, there's some kind of high level estimates we can use. Once they get it under contract, then it makes sense to look at a cost segregation study. And I'll just add in, Charlie, that the best time value of money benefit comes from doing a cost segregation study in the year you purchase the property.
Okay.
But that's not required. If you have a property that you bought 2, 3, 4, 5 years ago, you can still do, it's called a look back study. You can do a cost segregation study. You look back at what depreciation you've taken, and then you can take a catch-up adjustment for the difference, and that just runs through your return.
And would you do that all in the same, like a catch-up would be all 5 years in 1 year?
Yeah, so what you do is you look at the depreciation that you actually took on your tax return. So if you have everything in 27 and a half years, you look at, you know, that's the number you use.
Yeah.
And then you recompute depreciation using the basis that you should have used for 5 and 7 year property. And then you take the difference in those two numbers is your catch-up adjustment.
Okay.
What it's supposed to do is, it's often called a Section 481 adjustment. But what the adjustment does is it puts you where you would have been on the first day that you make the change, had you always used the 5 or 7 or 15 year recovery period.
So it's a way to recapture taxes that you paid.
In effect, yeah.
And so if you're looking to sell the property and you know that you've been paying out all these taxes over the years, it's very easy to figure out whether a cost segregation study or a look back study is going to benefit you.
That's right. That's right. And one point of caution, and sometimes people ask this question, I think it's a good question. You know, what happens with depreciation recapture, right? Because we know that, you know, that you take depreciation on personal property. When you sell a personal property, you got to recapture the depreciation deductions. And so that's one factor that goes into the analysis. And that's kind of where I get into the 5-year hold issue. Because you can, you know, if you do a cost segregation study, you may increase your depreciation recapture. That's just giving back the deductions that you took earlier. Sometimes, though, the personal property the value just goes down, so your recapture goes down also. Mm. But it's, you know, I don't know, I'm very much a believer in taking a look at the big picture. You know, what's the overall context? Does this really make sense to do this? And, you know, I'd love to sell cost segregation studies that everyone can use one, but I don't want to sell them unless they're going to benefit from them. So that's just one of those factors, looking at the big picture. And so,
and here's another thing is I'm thinking that when I have this conversation with our securities attorney when she's on our call, I'm thinking that I want to ask her, should we write the private placement memorandum? Should we write the operating agreement such that members of the LLC that qualify for, a full-time real estate investor status, they may be entitled to, more of the depreciation off the property than others at the discretion of, the manager or something to that effect, so that all PPMs that you're using are drafted in such a way that if you have to entice someone into the deal by giving them more depreciation, it's documented in the PPM, and you've protected yourself, and that way you can use that depreciation as another way of enticing investors into the deal.
Yeah, I think, that's not a bad idea. I would be careful though, because
Yeah.
I think what you're talking about is kind of template language. And then you've got to make sure that you have a checklist or something to, when you actually
You can't be vague. You got to be specific with it. You can't, you have to be very careful as to the discretion you use as to how you give it up to people. I mean, it's obviously, the thing is that it's, as you say, this is a benefit that can't benefit all of the members. It can only benefit those who qualify with the IRS.
Right. The real estate professionals.
Right.
I think it's a good idea to put something in. I'd just be careful to make sure, this has got to be solidified and modified and finalized.
Yeah. Now okay, so what's the cost? Give me an idea. So, you said that when you're starting off at looking at a property, $1 million property is where you should start at the basics. Go forward, like, what is that going to cost me? And what's a $5 million? Describe what it is that you need, and also tell us what it is that you need from us.
Sure.
In order to put together a study.
Yeah, so the cost really depends. It really varies on the property and the information that's available. $1 million property, I've seen cost segregation studies done for as low as $3,000-$4,000. That's pretty low. You get a $5 million, $10 million property, it can be 2, 3, 4 times more the work. I mean, there are economies of scale. You get a lot of, if you have an apartment complex and it's got 5 different buildings and they're all the same footprint and the same blueprint, there's economies of scale there. But it really just depends. And again, the return on investment can be 10 times the cost of the study, up to, I've seen them higher than 100 times the cost of the study. The information that you need to do a cost segregation study, kind of in descending order of quality, I would say. And the best information you can get is if you have the cost that a contractor actually charged the owner to build the property. If you can get those, often they're American Institute of Architect reports when the contractor will submit information to do a construction draw. That'll say, hey, we've done this amount of work. This is what and this is what we have left. So really what you want to get is the final draw that lists everything that the contractor has done. That's the best source of information. Often, and you can do a cost segregation study for new construction, or you can do it for an existing building. It doesn't have to just be, either one. You can do it for either kind of property. So if you're buying an existing structure, often those costs are long gone. You're never going to see them. So you can also do what's called an engineering takeoff off of blueprints. So if you get the blueprints for the building, the as-built blueprints is what you're looking for. Then you can go through and line out, okay, here's where the grass is, and here's the foundation, and they use this kind of construction for the walls. And you can rebuild. Basically what you're doing is rebuilding the cost of the building.
Now, this isn't something that has to be done right away. Like, how long does it take to get this done? And, at what point in the process can it be done?
Yeah, so this can be done pretty much any time. You can do, if you're buying an existing building, you can do the cost segregation study anytime after you purchase the building.
Okay.
And really, as long as you own the building, you can do the study.
Okay.
If you're doing new construction, the best thing to do is to get the person doing the cost segregation study involved while you're doing the construction. And so you want to get pictures to document the different kinds of property. And often in the construction process, it's helpful to get pictures during construction. But So that's, and then you can do it as long as you own the property. You can do a cost segregation study. You can do a look back. But going back just a second to the information you need, if you don't have blueprints, you can go in and take measurements of the property, and basically you're recreating the process a contractor would go through to do a bid to build the property, and then you use those costs to do the allocation. Sometimes taxpayers just do some kind of estimation technique, and depending on the experience, that can be pretty good, or that can be kind of a, disaster.
Yeah.
It can be hard to defend if the IRS comes in and looks at it.
I'll tell you the thing that I find very interesting is I always thought that the cost segregation had to be done like while you're buying the property, just you're setting it up as you're setting up the LLC so that you have that benefit going forward. But really, it sounds to me like if you're in the process of selling the property, and it takes, if you're doing it right, it takes 18 months for you to set that property up for sale. You've got to look at what you paid in taxes during the 5-7 years that you own the property, and whether, hey, maybe now we should do a cost segregation study for that look back ability and recapture some of those taxes that were paid.
You can absolutely do that. I would be careful though, because if you move a lot of property there's pros and cons to it. If you move a lot of property to personal property, you could be increasing your depreciation recapture when you sell it. So it could just be a quick 18-month turn. If you're considering they just changed the rules with like-kind exchanges. You can only do like-kind exchanges with real property. So if you're trying to line up yourself to do a like-kind exchange, that may be a reason to do a cost segregation study, just to separate out the personal from the real property. And there's questions about what personal property for like-kind exchange purposes, but that could be a reason why you'd want to do it when you're getting ready to exit.
Wow.
But yeah, I mean, if you're doing a look back study, you're effectively saying to the government, hey, I lent you a bunch of money, I want it back.
Yeah.
But you don't get any interest.
That's one loan I usually never get back. But the only time I've ever got money back is because of real estate. From the government. That's the nice thing about it. So, well, James, hey, listen, how can we get a hold of you? I want to put this will go in the podcast notes, so that people need to reach out to you and they want to talk to you about cost segregation. How do we get a hold of you?
Yeah. So my phone number, you can call me. My number 703-217-2179.
Cool.
And then, or you can shoot me an email, james@equalis.io, james@equalis.io, and I'd be happy to talk. And if I could just add in, Charlie, one thing that I think is really important is that when you're doing a cost segregation, it's very important to talk to your CPA or your tax return preparer, because you really do want to look at the big picture. What's going on? Does this make sense? Does this not? And often the person doing the cost segregation study, they're going to just give that information to the return preparer. They've got to get it on the return. So, I'll just say that I think that coordination is important.
Okay, so does the cost segregation expert have anything to do with the return? Like, do they review the return to make sure that the tax preparer did it correctly?
Well, typically they'll just look at the depreciation. If the return preparer wants them to look at the return, then they'll just look at the depreciation, make sure it's on there correctly. Okay, but typically it's just a handoff. The cost seg firm does the cost seg, and they give the results to the return preparer, and then the return preparer just takes it from there.
Cool. Excellent. All right, James, thank you so much for being on my podcast and waiting 50 years to be one of my first guests on the podcast. It's been great having you. And listen, I understand cost segregation now better than I did a half an hour ago, and I appreciate that, Jim. You really helped me out immensely. So I'm signing off until next week. Keep looking for deals, make offers, and get out there and get to work, and we'll help you out any way we possibly can. Talk to you soon. Jim, thanks. Give a big goodbye to my crowd.
Hey,
Jim.
Yeah, thanks, Charlie. Really appreciate being on. And, taxes can be often one of the largest areas where you can save money on your investments.
Tell me about it. I'm having a good tax year thanks to my bad real estate. So, yeah. Amazing how that works. Amazing, absolutely amazing. So, all right, James, thanks for everything, and we will talk to you soon.
Sounds good. Thanks, Charlie.
See you, man.
Bye.